Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast for this special episode 50. We dedicate a lot of airtime to finding great deals, running the numbers, like we did back in episode 21, and managing properties effectively, a topic from episode 18. But today, we're tackling something equally critical, yet often pushed to the back burner, especially when you're starting out, planning your exit strategy. Think about it. You put in all that effort to find and buy a property, maybe even complete a challenging rehab, which we discussed in episode 48. Fantastic. But how are you actually going to capture your profit? What's your specific plan to get your capital out, whether that's to reinvest in the next opportunity or simply enjoy the rewards? Ignoring your exit strategy is like meticulously planning an amazing cross-country road trip, but having no idea where you want to end up or what route you'll take. You might just find yourself stuck somewhere unexpected and undesirable. Today, we'll explore the very real costs of not having an exit plan, look at why investors often overlook this step, and give you practical ways to strategically plan your way out before you even get in. So what really happens when you dive into a deal without a clear exit path defined? It can get painful and sometimes surprisingly fast. Markets are dynamic, they shift. Life circumstances change. Think about the investors who bought properties anticipating quick appreciation in early 2022, just before mortgage rates began their steep climb later that year and into 2023, surging from historic lows to over 7%. That rapid shift dramatically cooled buyer demand in many areas. Now, if an investor's only strategy was a quick flip, they suddenly found themselves in a tough spot, potentially trapped. Carrying costs, the mortgage, taxes, insurance, keep coming due month after month while the property languishes on the market. And while recent data shows home sellers are generally still profitable compared to historical norms, the profit margins have definitely tightened compared to the peak frenzy years, meaning there's simply less cushion for delays or mistakes. Selling at a loss becomes a very real risk for investors caught off guard by market shifts without a flexible exit plan. Industry reports consistently point to poor planning as a key contributor when investments underperform. It seems pretty clear that planning your exit is vital. So why is it so often neglected, especially by those new to investing? It usually boils down to a few common reasons, often overlapping. First, there's what I call deal fixation, the process of finding the property, analyzing it, negotiating, and securing financing, and finally closing. That feels like the main accomplishment. It's exciting. Investors get so focused on just getting the deal done that thinking about the end of the deal gets pushed aside. Planning the exit feels less urgent, like a problem for future you to worry about. While specific survey numbers fluctuate, it's a widely recognized phenomenon in investor circles, like those on BiggerPockets, that insufficient exit planning is a common source of regret later on. Second, there's optimism bias. It's human nature to hope for the best. It's easy to assume the market will keep appreciating steadily, that finding great tenants will be simple, or that eager buyers will line up and pay top dollar exactly when you want to sell. While staying positive is important, realistic projections based on data are absolutely essential. Overestimating potential returns or underestimating how long it might take to sell or rent is a classic mistake, often fueled by incomplete research or just wishful thinking. And finally, there's often simply an experience and knowledge gap. Newer investors might not fully grasp all the components of a comprehensive exit strategy, analyzing market cycles, running accurate resale comps, understanding different financing options like cash out refinance, or navigating the complexities of capital gains taxes might feel like advanced topics. But neglecting this crucial planning stage, a core part of the P for prepare in our prime investing framework, discussed back in episode 15, is like setting sail without knowing how to navigate back to shore. Okay, we understand the why. Now for the important part, the how. How do you proactively build a solid exit strategy before you commit to an investment? The great news is planning your exit isn't some mystical art. It's about strategic thinking and preparation. Here's a practical framework to follow. Step 1. Define your primary goal and intended path. What are you trying to achieve with this specific property? Is the main goal short-term profit via a flip, or are you focused on long-term wealth building through buy and hold rentals? Your primary objective will shape your initial analysis and timeline. Flippers focus heavily on after repair value, ARV, and speed, while buy and hold investors focus on sustainable cash flow, tenant quality, like we covered in episode 47, and long-term appreciation. Step 2, establish a realistic holding period and exit trigger. Think about your time frame. Roughly how long do you intend to hold this asset? 6 months, 5 years, 10 years or more? And just as important, what specific event or condition will trigger your exit? Will it be hitting a predetermined profit percentage, reaching a certain equity level, observing specific market indicators suggesting a peak, or maybe it's tied to a personal life goal, like retirement? While market timing is difficult, remember that longer holding periods generally provide more cushion against transaction costs and allow more time for appreciation to work its magic compared to the higher pressures of short-term flips. Step 3, analyze multiple potential exits. This is absolutely key for building flexibility. Don't just analyze your preferred exit, look at the alternatives. If planning to flip, you must rigorously analyze recent, truly comparable sales, resale comps from the MLS, or reliable data sources to establish a conservative ARV. Don't just hope for top dollar. And critically, factor in all selling costs, commissions, closing costs, staging, etc. If planning to hold, can you also sell it profitably if needed? What's the likely sales price based on current comps? And importantly, even if you plan to flip, analyze the rental exit. What are current rents for comparable properties in that specific neighborhood? Could the property realistically cash flow today if your flip plan stalled? Running the numbers for both scenarios gives you options. Step 4, build in your plan B and maybe plan C. Market conditions are not static. What will you do if plan A fails? If the flip market suddenly cools, is renting it out a viable fallback based on your rental analysis? Pivoting to a rental strategy is a common and often necessary backup plan for flippers when sales unexpectedly slow down. If you plan to hold long-term but encounter a major capital need, could a cash-out refinance be a possibility later on? Having these contingency plans thought out beforehand provides crucial adaptability. Step 5, consider the tax implications seriously. Exiting an investment triggers tax consequences. Selling a property you've held for less than a year typically means profits are taxed as short-term capital gains, hitting you at your ordinary income tax rate, which can be as high as 37%. Holding for more than 1 year qualifies profits for the much lower long-term capital gains rates, 0%, 15%, or 20% for most investors, depending on their overall income. This difference can dramatically impact your net return. So factor it into your timing and strategy. It's always wise to discuss potential tax implications with a qualified tax professional who understands real estate. Here's the essential takeaway for us prime investors. An exit strategy isn't just a nice to have, it's a fundamental part of your initial investment planning and research process, right alongside analyzing the deal itself. It's your roadmap for getting your capital and profits back out. Buying property without knowing how and when you plan to exit profitably is leaving far too much of your financial future to chance. Now, your challenge today. Take a look at a property you either own now or are currently analyzing. Right now, clearly define 2 distinct exit strategies for that specific property. What is your plan A? What is your plan B? What specific conditions, market indicators, profit levels, personal timelines would trigger each exit? Start practicing the discipline of thinking with the end in mind, right from the beginning. And as always, if this episode provided value, please subscribe to the 5-Minute Prime podcast, share it with fellow investors, and leave us that review. Find more resources at reiprime.com.